If you sell your home for a profit, how much tax will you owe? There's a chance you may not owe any, but it's also important to know what that's going to look like. In the next few minutes, Andrew and I are going to try to help explain how that calculation comes about.
So when we say profit, whether it's a stock or real estate, what we're talking about is um, the capital gain, is what you bought it for versus what you sold it for, right? So if there's a positive gain there, that would be what you potentially could pay tax on. But a primary residence, so your home, has very preferential tax treatment when it comes to this versus, say, selling a stock or a fund. So if you bought your home for $300,000 and you sold it for $500,000, you wouldn't have to pay tax on that full $200,000 of gain if it was your primary residence and if it qualified under the primary residence exclusion rule, John, which is
Well, the exclusion is $250,000 for an individual or $500,000 for a married couple. Um, and this is different from the old law. It used to be you could sell your house and roll the gains into a new house and not pay tax, but that's gone. This changed back in 1997 when they went to this capital gain exclusion. Now, there are some requirements for this. You had to have owned your home for at least 2 years. Your house must be your quote unquote primary residence for 2 out of the last 5 years. That's important to understand. It doesn't mean that you had to be there 2 years in a row. You could be there for a year, move out, come back for a year, as long as it's 2 out of the last 5 years. It doesn't have to be a continuous time frame. And you also don't get to use this exclusion more than once every 2 years in general. So you can't just jump from house to house and try to take advantage of it. There's a time limit there to be aware of as well. But yeah, a quick example, back to Andrew's example, if it was a married couple that bought the house for 300,000 and sold it for 500,000, that's a $200,000 gain. They get up to a 500,000 exclusion, thus no tax. Now, there are other things, Andrew, that can factor into that gain. What are some of those?
yes. And one other thought, or one way I think it's easy to think about it, when you sell your house, if you're playing that 2 out of 5, you basically have 3 years to sell it and still get that 250 or $500,000 exclusion. So it's not like you have to sell the next day to get it. You have 2 out of 5, so you've got 3 years from that date of sale, um,
From the date you move out.
from the date you move out. So the biggest thing to factor in and to keep close track of when it comes to trying to reduce the tax on the sale of a house is improvements you've made over the years, because those improvements can be added to what you bought it for, and then added to that is that 200, 250, or $500,000 exclusion, and suddenly you're really minimizing the gain and the potential tax on the sale. So, for instance, if you bought it for 300 and you sold it for a million and you had 700,000 of gain, well, if you're a married couple, you're going to owe on 200 of that. But if you had put at least $200,000 in that house, you would owe zero.
Well, and we refer to this as cost basis. So like your original purchase price, the 300,000, that's part of your cost basis if you do an improvement.
Right. And it has to be, so on improvements, it has to be a capital improvement to the house. It has to be a material improvement. It can't just be normal upkeep, painting, minor fixes, cleaning. It would be major remodels. It would be adding square footage to the house. It would be a new roof or a new HVAC, that are within a relatively close period to selling the house. So it has to be considered a capital improvement to the house. I always err on the side of record everything, right? Just have your list of everything you put into the house. Your CPA can tell you if any of those things would be excluded, but better to have all of it in front of you.
It's good to keep these records as you live there because if you've been in a house for 10 or 15 years, it's going to be tough to go back and try to remember and find proof of everything that happened. So we always encourage clients have a file on your computer or a file folder, put everything in there. It's going to make your life a lot easier on the back end when you go to sell it. But in the event that you do have a taxable gain, what does that look like? Well, it depends on what your long-term capital gain tax rate is. That can be 0% for some people. It can go all the way up to 20% for others. Most people pay 15% capital gains tax, but it depends on what your income is for that calendar year in which you sold your house. So
Right.
it's important to consider that. But as with anything with taxes, the rules can get complicated fairly quickly. So it's important to talk to a tax professional if you're considering selling your house so that you can kind of know what it's looking like, especially if you're planning on using the money to buy a new house.
Right.
You don't want any bad surprises there.
Right. And we, of course, always happy to start running a projection of what it would look like well ahead of the time that you actually sell your house.
We hope you found that helpful, and let us know if you have any specific questions.